Hey everyone, welcome back to my channel, Canadian Whiteboard Finance. This is the place where I take complex financial concepts, make them simple, draw them out on whiteboards, and really my goal is to help Canadians make better informed decisions around their finances, how they invest their money, and where they invest it. So today I'm going to focus on the RRSP, the Registered Retirement Savings Plan. Basically going to answer the top questions I get and have gotten over the last many years as a financial planner, lay them out, draw them out so they can be understood. So that sounds good to you? I'm going to get started. All right, so the RRSP. So this video is for you if you are wondering, like if you're much like I was before I became an advisor, started looking at saving some money and was unfamiliar with these terms really. It's RRSP, TFSA, there's so many other, alphabet soup things, GIC, LIRA. I mean, I could go on and on. Financial planning is full of sort of acronyms. So I was confused. People were telling me to do this one or do that one. So really at the end of the day, I'm hoping my goal for you is that you understand it better than you did when you started. If you're either very confused about how they work or you have one, but just want to make sure that you are, that you understand all the ins and outs of it, that's what I'm going to go through today. So first off, what is the RRSP? What is the Registered Retirement Savings Plan? I'm just going to say RRSP because Registered Retirement Savings Plan takes too long. So what is it? It's basically a type of an account. So think of it as a bucket, much like the TFSA. If you've seen my TFSA video, it's a bucket where you can put money in and you can invest it into different things. You can invest in very low risk things. You can invest in anywhere from low risk to high risk and anywhere in between. One of the misnomers or I'm a bit of a linguistic stickler. People will say, oh, I buy RRSPs. Yeah, you don't really buy an RRSP. You open an account and you put money into it. You invest in the RRSP. When people say buy RRSPs, it makes me think that they think there's only one way to use the RRSP or one thing to invest in, which is not the case. So I'm not picking on you if you've said you've bought an RRSP, but it doesn't really make a lot of sense. I've invested in RRSP. So it's an account where you can put some money in. It has some special tax treatment, and I'm going to talk about that. So I forgot the money symbols here. So you got money. You're putting it into the RRSP and you're investing inside of the RRSP. The whole point of the RRSP is for it to be worth more when you go to take it out than it was when you started, and you get some tax advantages that I'll talk about, and it should be part of a bigger plan. So RRSP is just one piece of the puzzle. If you'd like to know more about full financial planning, go through the exact process I take my clients through, be sure to click on the link in my description and you can download your free 30-minute guide to Canadian finance and get on my email list. So that's what the RRSP is. All right, so who can have an RRSP? So it's different than the TFSA, if you've seen my TFSA video, in that there isn't necessarily an age at which you start getting your RRSPs. It's really just whenever you start working, you start generating a T4 income, you start making money, that means that you start generating RRSP room. So if a person in the first year that they make some money and they're filing their taxes and getting a T4 income, they can contribute to their RRSP in the following year. Have to be working in Canada, resident or citizen, making a T4 income. If it's a business owner, the business owner has to be paying themselves T4 income. If you're paying yourself a dividend, it does not create T4 income, T4 RRSP room because you're not doing T4 income. So that's one thing to note. So living in Canada, making money in Canada, generating T4 income. So earning an income. So how much can you contribute? So the RRSP has limits as to how much you can put in, and it's the amount that you can put in is determined by how much money you make. So just to use an example, so it's 18%. So let's say here's me or someone making some money. The way that it works is I'm just going to use numbers for round numbers sake. Let's say that someone made $100,000 in year one. That means the next year they have, so this is their income. That means the next year 18% of that is RRSP room, which would be $18,000. So they could contribute $18,000 to their RRSP. And if the next year they make another 100, then it just keeps going. That 18 gets tacked on again. So to a total of 36,000 is the maximum they would be able to put in. Now, what you need to know about that is, so there is a maximum amount you can put in. So it's 18% of your salary, and the maximum amount right now, like in this year of 2020, if you're watching this in 2020, 2021 will be a little bit different. $27,230. So someone has to make in the neighborhood of $150,000. You're making $150,000. You're a little bit more than that, but you're basically maxing out the 18% at 27,230. So not a number that everyone hits, but it's just important to know. Shouldn't put in more than that because you will be penalized for putting in more than that. So 18% of your salary, and it accumulates. So if you don't use it, it does accumulate. Now, to talk a little bit about what happens when you contribute. Oops, didn't mean to draw there. What happens when you contribute to your RRSP? Like I said, there is a tax. One of the reasons people do it is because they do get like a tax savings. I'll talk a little bit about that because there are some misconceptions about that. So what happens when you contribute is, I'm going to stick with that 100,000 example just because it's a round number, but it works for, other numbers of people putting money in. So let's say that person generated that room and they've made their 100,000 and now they have 18,000 of RSP room. So this is the income they've made of 100,000, and they've generated 18% of that, so 18,000 of RSP room. If they take the 18,000 that they made and they put it into an RSP, so this is like the RSP bucket, it basically takes that amount off of their salary, so they're not taxed on this last little bit. So basically they're only taxed on the 82,000 that they made under that. So especially in those higher income brackets, it saves a lot of taxes. In the lower ones, not as much, but it does save. So just using this example, option A is that the person does contribute to the RSPs. Option B is that they don't. The amount of taxes that they will save, so you have to understand they have put that $18,000 into the RSP, so they don't have that money sitting, in their bank account. But they would pay, the person who doesn't put money into their RSP would pay, in this case, approximately $6,300 more in taxes if they did not put money into their RSP. So it's one of the things, government created it to incentivize people to put money away, and getting the tax credit is a bit of a way that encourages people to put that money away. Now, what are the top ways you can get your money back out of the RSP? So you can technically pull your money back out of your RSP whenever you want, but it is going to be taxed as income, and you are there's going to be a withholding tax. At the end of the day, depending on how much you take out, there's different amounts of withholding tax, and you're going to be taxed as income. So really, the idea behind the RSP is to put the money away and not take it out for a while. But so the normal, like under normal circumstances, the ways that people take it out is they either retire. They use it, they borrow against it to buy a home, or they go back to school. This one's a little bit rare. I haven't seen that one too much, but number one way that people access it is when they go to retire. So the idea is that they've been putting money inside of their RSP over the years. They've been investing it. It's been growing such that when they go to retire, so they're working, putting the money in, working years, boom, retire. Now they start taking that money out as they retire. And you are forced to start taking the money out at 71. So you have to start taking out a minimum at that point in time. So that's the idea behind it, is people use it in retirement, and there's a formula for how much you have to take every year. So it's pretty much depleted once you're into your 90s. That's the idea, is around 95, you've pretty much depleted it. And if that is the case, you've either taken the money you took out and put some of it somewhere else, or you're getting money from somewhere else. So that's the number one way. And you will pay taxes when it comes out. So the idea behind the RSP, because you might be wondering, well, why would I put money, like why would I do this if I'm going to pay taxes in the end? The idea behind it is that when this person, so just to keep with the $100,000 income idea, this person is paying taxes at a high rate. So the idea is that they put some money into their RSP to reduce that, and then, so this is while they're working, and then when they go to retire, they don't have as much. So someone who doesn't have a pension, for example, would typically have a much lower income. Now when they go to take those, so they put the money into this RSP. Now when they go to take it out, that income is being tacked on top of lower income brackets. So the idea is that you're putting it in, saving taxes when your taxes are high, taking it out when your taxes are lower. But if someone has a really nice pension, that doesn't always happen. That's one of the problems I help people solve. Buying a home, so I'll erase this to give us a little bit of room over here. Buying a home is another one. So if you're buying, I won't go into tons of details around this, but if you're buying your first home, typically that's when you can borrow against it. So you've got your RSP, you can borrow against it to buy your first home. The idea being that, young people might think, someone who's starting out or trying to buy their first home might be like, yeesh, I don't want to put away all this money and I can't get at it? What if I want to buy a home? So you can take out up to $35,000 to put a down payment on a house. You do have to pay it back over a number of years, but it is a way that you can use the money. Next, going back to school, you can take up to $10,000 a year times 2 years as an adult learner to pay for education. So another way that they've made it a little bit more flexible over time. This is supposed to be a diploma. Like, what is those, like, graduation hats with a tassel? There we go. It's about as good as the extent of my artistry. So those are the 3 top ways. Number 1, obviously, like most people I meet with, that was their intent, retire. Number 2 is buy a home. Number 3 is go back to school. You can take it back out in an emergency, but you're under almost all situations, you're going to have to pay some taxes to take it back out. Now, the next is your estate. So if you're really young, you might not be thinking about this, but it is something that I help my estate planning clients with. When someone passes away and they have money inside of their RRSP, so let's say this is the money they've saved up, in that final year of life, most people have made some income either from something called old age security or Canada pension or their own pensions or investments. So their income, under almost all circumstances, there's some exceptions, but all that RSP gets tacked onto the income. So in some cases, people will send half of what's inside. I'll try to draw that a little bit more on the half. They will send half of what's inside of their RSP, still didn't do half, to taxes, and half to their loved ones or whoever they've put in their, whoever they've considered as part of their estate plan. Pretty common that I see that people have a lot of money in their RSP when they go to retire. I don't know how the next 20 years will look like for people, but right now I work with a lot of people in this situation where about 50% of what's inside of there is going to go to the estate and, to taxes, and the other half is going to go to the beneficiaries or the estate. And one final thing I'll say about when it comes out as income, I just remembered last time I gave a webinar, someone asked me this. When you go to retire, it doesn't matter how you've invested it, because it's another topic for another day, but depending on if you're investing outside of an RSP in what's called a non-registered account, different types of investments get taxed differently. Some are taxed as income, some are taxed as half as much. With the RSP, it doesn't matter how you've invested it inside of there. Everything that comes out as income, and it all gets taxed in your hands when it comes out. Under a couple rare circumstances, like a dependent child of special needs or things like that, there are ways to access it. But if you have any questions around that, put that in the comments. Great. So at this point, I hope you have a clearer picture on how the RSPs work. If you have any questions, please put them in the comments. I'll be sure to answer them. And the RSP is just part of a much bigger puzzle that I help people figure out. And you can get access to exactly the process I take my clients through if you go to the link in my description, where you can download your free guide, 30-minute guide to Canadian finance, and get on my newsletter list. And while you're waiting for the next video to come out, I have 2 more over here. Let's see if I can point to where they should be. Here and here. RSP versus TFSA, and then the TFSA explain, if you're still wondering how TFSAs work. So thank you so much for joining me, and I'll see you in the next video.